Welcome back. Well, it's time to distill things down to stocks that we need to keep our eye on today. Our research team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, hi, morning. Rima, let's start first with the results. So Vodafone Idea in focus. How do those numbers look?
Well, the key highlight is the losses have come down for the company. So the loss this quarter at 6,400 crore is down 1,200 crore on a quarter-on-quarter basis and down about 1,400 crore on a year-on-year basis. The key reason is, remember, the company raised money via that FPO and that has gone in bringing down their bank debt, and therefore the interest cost has come down for the company, and that's helped bring down the losses for the company. That said, it's still a big loss of more than 6,400 crore rupees. The second positive is, with that money raised, the company is upping its capex spend. So the capex spend this quarter at 760 crore is higher than what they did in the prior quarter. But the results of this are still yet to be seen. So the company's revenue growth continues to trail peers. Revenues have declined for the third consecutive quarter and are down close to about 0.9%. Margins are largely stable at about 40%. 4G subscribers have gone up, but the overall subscriber headcount continues to decline, and ARPUs for the company are largely stable.
Okay, all right, Rima, thanks a lot for that. Well, I'm looking at NMDC and I'm going with green on this one because the numbers on an operational parameter are better than what we work with. On the top line, there's a small miss. The EBITDA number is much better. The margins are much better. And in turn, the profitability as well is much better. Remember, we already have the provisional volumes with us. So, the realization is something that you're looking with. And the realizations on a year-on-year basis as well as a sequential basis are higher. The problem is, post the end of Q1, they have taken two large price cuts of more than 1,000 rupees, which will be on Q2 numbers. So for the time being, these numbers look good. Then how did they beat in terms of the margins? Because of royalty, since they produce less, the royalty as a percentage of the total sales mix, that came down to around 37%. Over the last many quarters, it's been between 41 to around 43%. So that's the reason that these numbers look better. But there are risks going ahead. For the time being, these numbers are better than what the street was working with. So let's move on then to a couple of more stocks. Vamakshi joins us to tell us about HUDCO and IRFC. Morning, Vamakshi.
Well, good morning, Nigel. HUDCO reported a good set. Therefore, I'm going with the green for this counter. In fact, there was a slight miss on the net profit, but that was mainly on account of higher interest costs. Disbursements came in at 12,625 crores for the quarter gone by. This is a rise of almost 19 times YOY, and this growth is largely being led by the disbursements in urban infra. Loan book saw an uptick of almost 30% on a YOY basis and has surpassed street estimates. NIMS, however, has contracted to 3% both on a YOY as well as sequential basis. Given the good growth in loan book, however, the NII is seeing an uptick of almost 12%. PPOP was up nearly 16% and net profit saw an uptick of almost 25%. The asset quality too has improved for the company by almost 29 basis points at the GNPA level and the NNPA came in at 0.33%. This is an improvement of nearly 3 basis points sequentially. IRFC, on the other hand, reported a decent set. The company was in focus yesterday after the cabinet provided a nod to the railway projects, but today it's in focus on the back of a decent set of numbers. Mild green is expected there because NII was up only 2% YOY, PPOP was up 1.8%. They had a provision write back of 3.62 crores as compared to a provision of nearly 50 lakh on a sequential basis. The net profit too saw an uptick of 1.8%. So overall, a decent set, going with a mild green for IRFC.
Okay, all right. Thanks a lot for that, Vamakshi. Getting back to metals then, Hindustan Copper, these numbers look good on a year-on-year basis. The problem is these numbers are backdated because as we have seen in the last 45 days or so, metal prices have come off substantially from the recent peak. And that's why the stock that was close to around 400 rupees has come down to around 300 rupees. Let's run you through the numbers first. On a year-on-year basis, good growth on the top line. EBITDA number more than doubled. And margins on a sequential basis are more or less stable. They've come off a little bit, but on a year-on-year basis, they look much better. The profit number as well, because of the higher operating profit, we are seeing that flows through. And the reason that the margins are a beat is because other expenditure has gone up by only around 8%, while the revenue has gone up by around 33%. So as a percentage of the sales mix, it's come down to around 38%. The problem for Hindustan Copper is that prices have come off and the stock trades at around 100 times its trailing earnings even as of now. So expect it to open up in the green, but from there it could give back some of that advantage. Going back to Rima though, Rima, focus on tech. Happiest Minds, how are the numbers?
So Happiest Minds top line looks very strong. So the company's dollar revenue growth has increased by 10.9% on a quarter-on-quarter basis. This is on account of the two acquisitions, PureSoft and Aureus, that the company did. So that boosted the company's top line. EBITDA margins for the company have declined, on a quarter-on-quarter basis. But the way the company calculates margins is different because they include that other income. But the way we calculate EBITDA margins, it's down on a quarter-on-quarter basis by 160 basis points. Profits are down 29%. And here there are two reasons. One, there was an exceptional gain in the prior quarter of about 13 crore. And two, because of these acquisitions, the companies had to make certain non-recurring investments which have depressed the company's profits in the current quarter. But the top line growth is very strong on account of the two acquisitions. Back to you.
Rima, thank you very much for that. Well, the stationery product maker DOMS should also be in focus. Upasana is here with details. Upasana, morning.
Good morning. Thanks so much for that. Well, strong set of numbers reported by the company with a revenue growth of 17% on a YoY basis. EBITDA stood at 86 crores with an uptick of 38%, and margins also expanded sharply by 290 basis points at 19.3%. PAT stood at 54 crores with a growth of 50% on a YoY basis. Now, the company says that it continues to see momentum in sales growth and improvement in the margins going ahead. It aims to expand its presence in the product lines associated with kids, children and young adults. Hence, the board has approved an investment of 55.5 crore for acquiring majority stake in Uniclan Healthcare Private Limited, which is a company engaged in baby care and disposable hygiene care products. Company aims to enter a new range of products with this proposed acquisition.
All right, Upasana, thanks very much for that. So we'll watch out for DOMS. Let's look at some more earnings. We've got Mangalam joining in to take us through Senco as well as Campus Active. How were the numbers, Mangalam?
Well, for Senco, the revenue was largely in line with the first quarter update that the company had given. 11% jump in retail sales, 4% same-store sales growth. No worries out there. The EBITDA saw a 60% jump and the net profit saw an 85% jump. But here's the catch. It was led by inventory gains. So remember, during the first quarter, gold prices increased by about 10% and 5% of the company's gold inventory is unhedged. So they recognize those gains on that. In fact, going forward, this could be a bit of a problem because they said that reduction in customs duty will impact margins for the next couple of quarters. So while Q1 was good, the next couple of quarters margins would be impacted, and that's why I'm going with a red for Senco. For Campus Activewear, let's just say that this hasn't been a quarter for any of the footwear makers. Here, Campus wasn't any different either. 4% decline in revenues, 22% decline in EBITDA, and as a result of which there was a 20% decline in the profitability as well. The company did cite muted demand scenario across both rural and semi-urban areas, and add to that, even the average selling price declined from 629 rupees per pair to a little above 580 rupees per pair as well. So see some red on Campus.
Okay, all right. Thanks for that, Mangalam. Well, let's wind this down with Vivek, who's here to tell us about Kpi Green and their fundraising plans. Morning, Vivek.
Well, good morning. Kpi Green, we accessed the term sheet for this particular fundraise. So the route that they're taking is via the QIP route. The company is looking to raise close to 1,000 crore via this particular route. The floor price for this particular offer is at 983 rupees a share. The indicative issue price is close to 935 rupees a share. What does this mean? It's a dilution of 4.4% if you go by the base size of the deal. Dilution of close to 9%, if the company chooses to go ahead and exercise the upsize option for this particular deal. Going with the red on the back of the fact that there's a significant discount to the last traded price.
Okay, that's Kpi Green. Watch out for it. But Vivek, hang on. We want to come back to you for another important update. But before that, quick recap of the top stocks to watch today. The ones that have positive news flow around them are Vodafone Idea, NMDC, HUDCO, IRFC, Hindustan Copper, Happiest Minds and DOMS. Stocks with negative news flow around them are Kpi Green, Senco Gold and Campus Activewear. Now, a lot of these stocks are earnings-based in terms of why we're watching out for them. There are going to be others which we will watch out for because of the MSCI index weight increases or decreases or exclusions or inclusions because the review is happening. So let's go back to Vivek for this. The August review is here. Vivek, tell us the highlights.
Well, that's right. So the August review is here. The list of inclusions and exclusions is out. India's weight in the emerging market index rises to 19.8% versus around 19.4% that it had as part of the May review. So the main index that we track is the MSCI Standard Index, where there will be 7 additions and 1 deletions. Which are the additions? Zydus Life, as per IFL Alt, expect to see flows of close to $218 million. Prestige Estates, you also have Dixon Tech, OFSS, Oil India, Vodafone Idea, as well as RVNL. Remember, most of the quant analysts actually had these names penciled in as likely inclusion candidates. One deletion is there from the MSCI Standard Index, and that is Bandhan Bank. Close to $109 million worth of selling will be seen. All of these changes will be implemented on August 30th, the trading session on that particular day. Another important stock that was on the radar ever since HDFC Bank uploaded the shareholding pattern, there was enough foreign room for MSCI to go ahead and increase the weight. Along expected lines, MSCI has increased the weight for HDFC Bank, but they have chosen to do so in two separate tranches. So there will be close to $1,472 million or $1.4 billion of inflow on August 30th in HDFC Bank, and there will be another weight increase that MSCI will implement, and this will be done as part of the November review. Another important update, the Adani Group stocks are now, all of the embargo that was there on these stocks have been lifted, and now they will be treated, they will receive standard treatment as far as the MSCI list.
All right. Thank you very much, Vivek, for that. So that's an important list, and we'll talk more about this with an expert in just a bit from now in terms of implications for these individual names. But we'll take a break. We're back. Amnish Agarwal of Prabhudas Lilladher will be joining in for some specific stock conversation. Stay tuned.